Hey everyone, welcome back to the channel. Today we're talking about one of the safest and simplest ways to grow your money in the United States, the Certificate of Deposit, or CD. If you're looking for a way to earn more interest than a regular savings account without taking on much risk, a CD could be the right option for you. Let's explore what it is, how it works, and whether it's the right fit for your savings plan. A Certificate of Deposit, CD, is a savings product offered by U.S. banks and credit unions. It allows you to lock in a lump sum of money for a fixed period in exchange for a guaranteed interest rate. At the end of the term, you get your original deposit back, plus the earned interest. It's a safe and predictable way to grow your savings. Note, if you're in Canada, the closest equivalent to a CD is a Guaranteed Investment Certificate, GIC. Both products work similarly, offering a fixed return over a set period, but the names and markets differ. Here's a quick breakdown of how CDs work. You invest a lump sum of money for a specific term, such as 6 months, 1 year, or 5 years. Fixed interest rate. The bank locks in your rate at the time of deposit, meaning your returns are predictable. Maturity. Once the term ends, also known as the CD maturing, you get your initial investment plus the earned interest. If you withdraw your money before maturity, however, you may face a penalty. Now, you're probably wondering, how much can you actually earn with a CD? The return you get depends on the interest rate and the term you choose. Let's go over some examples. Imagine you invest $10,000 in a CD with a 1-year term and an interest rate of 4%. Over the course of 1 year, you'll earn interest based on the principal amount of your investment. In 2024, you invest $10,000. By the end of 2025, your investment will have grown by 4%, earning you $400 in interest. So after 1 year, your total investment will be worth $10,400. Now let's say you invest $10,000 in a CD with a shorter term, 30 days, and an interest rate of 2% annually. Since this is a short-term investment, the interest is calculated for the 30-day period, not the full year. In February 2024, you invest $10,000. By March 2024, your CD earns interest at 2%, which amounts to $200 annually. However, since the term is only for 30 days, you'll receive a proportionate amount of interest. So after 30 days, your total investment will be worth $10,016. Wondering how a CD stacks up against a regular savings account? Here are the key differences. Higher interest rates. CDs generally offer better rates because your money stays locked in. Limited liquidity. Savings accounts let you access your funds at any time, but CDs require you to leave your money untouched for the term. Risk. CDs are considered very low risk since they're FDIC insured. Let's dive into this point a bit further. When it comes to safety, CDs are considered one of the lowest risk investments thanks to FDIC insurance. This insurance protects up to $250,000 per depositor, per institution, and per ownership category. So even if the bank were to go under, your savings would be safe up to that limit. A real-world example is the collapse of Silicon Valley Bank, SVB, on March 10, 2023. Many depositors who had accounts exceeding the FDIC limit faced uncertainty. However, those with deposits under $250,000 were fully protected by FDIC insurance, showing how important it is to stay within insured limits. Now, what if you've got more than $250,000 to invest? That's where strategy comes in. You could spread your money across multiple FDIC-insured banks. For example, placing $250,000 in 2 different banks gives you $500,000 in insured savings. Some banks also offer services like Certificate of Deposit Account Registry Service. With this offering, your deposit is spread across several banks, so you get full insurance on a large amount without managing multiple accounts. This way, no matter how much you're saving, you can rest easy knowing every dollar is protected. There are different types of CDs to suit your financial needs. Traditional CDs, fixed interest rate and term. Jumbo CDs require large deposits, usually $100,000 or more, with higher rates. Bump-up CDs. If interest rates rise during your term, you can increase your rate once. No penalty CDs. These allow early withdrawals without a penalty, but rates tend to be lower. Let's dive into bump-up CDs a bit further. It sounds a bit more complicated than the standard ones, doesn't it? A bump-up CD offers a unique advantage. If interest rates rise during your CD's term, you have the option to bump up your rate to the new, higher rate. This type of CD gives you some flexibility that traditional CDs don't offer, especially in a rising rate environment. Here's how it works. Let's say you open a 3-year bump-up CD at a 4% interest rate. If the bank increases the rate for new 3-year CDs to 4.5% during your term, you can request to adjust your CD's rate to match the new one. However, there are some limitations. Most banks allow only one bump-up per term, so you'll need to time it wisely. Bump-up CDs may start with a slightly lower initial rate than regular CDs, as the option to increase the rate provides added value. This product can be a good choice if you expect interest rates to rise, but still want the stability of a CD. However, if rates stay flat or decline, you won't benefit from the bump-up feature. But CDs aren't perfect. Here are a few downsides to consider. Low returns. Compared to other investments like stocks or mutual funds, CDs offer lower returns. Locked-in money. Your money is tied up for the term, and withdrawing early can come with penalties unless you have a no-penalty CD. Inflation risk. If inflation rises higher than your CD interest rate, your money could lose purchasing power over time. This is where the bump-up CDs could help. CDs are a great option for people with extra cash they don't need access to for a while, such as funds earmarked for future goals like a down payment or college tuition. Investors seeking stability and predictable returns without the risk of market volatility. Savers who want low-risk, FDIC-insured returns to protect their money. While CDs offer excellent security, they may not be the best fit for emergency funds, which need to be easily accessible. Since withdrawing from a CD before it matures can result in penalties, it's better to keep your emergency fund in a more liquid option, like a high-interest savings account or money market account. In the U.S., CD rates are influenced by the Federal Reserve's interest rate decisions. When the Fed raises rates, banks often offer higher CD rates to attract deposits. However, when rates are low, CD returns also drop, making other investments more attractive. CD rates have fluctuated over time. During periods of low interest, like the aftermath of the 2008 financial crisis, CDs didn't offer much return. However, more recently, with the Fed raising rates to the highest levels in decades, CDs have become more appealing. Historically, long-term CDs came with better rates to entice savers to keep their money with the bank for an extended period. However, as rates has started going down in the past few months, we are observing that the banks are more willing to offer a high rate on a short-term CD. Banks are hesitant to offer that same high rate on a long-term CD, since the federal funds rate could drop more during that CD's lifespan. Be sure to compare rates across banks before choosing a CD, as the difference between institutions can be significant. Now, let's talk about taxes. In U.S., interest earned on a CD is considered taxable income, but the tax treatment varies depending on where you hold the CD. If it's in a tax advantage account like an IRA, the interest could grow tax-free until you withdraw it. One last tip, let's talk about CD laddering. CD laddering is a strategy that allows investors to take advantage of higher interest rates while maintaining liquidity. Here's how it works. Instead of putting all your money into a single CD, you divide your investment across multiple CDs with varying maturity dates. For example, you might invest in 3 CDs, one that matures in 1 year, another in 2 years, and the last that matures in 3 years. As each CD matures, you can either withdraw the funds or reinvest them into a new 3-year CD. This approach offers several benefits. Liquidity. By staggering maturity dates, you ensure that you have access to some of your funds every year, reducing the risk of being locked into a long-term investment. Higher returns. CD laddering allows you to capture higher rates on longer-term CDs while still having short-term access to your money. Flexibility. If interest rates rise, you can reinvest maturing CDs into new ones at potentially higher rates, maximizing your earning potential. Overall, CD laddering is an effective way to manage your savings while balancing the trade-offs between returns and access to cash. In summary, certificates of deposit are one of the safest ways to grow your money with minimal risk. While the returns may not match high-risk investments like stocks, CDs provide stability and predictability, making them a solid option for conservative investors or those looking to diversify. If you're in Canada, consider a GIC, which works similarly but within the Canadian market. That's it for today's video. I hope this gave you a good understanding of how CDs work and how they can fit into your financial plan. If you found this helpful, don't forget to like, subscribe, and leave a comment. Thanks for watching, and see you next time.